In this video, I'll show you the best day to pay off your credit card to boost your credit score. We'll look at what the credit agencies are measuring to calculate your credit score and what you can do to pay less interest on your student loans, your mortgage, your insurance, or anything that involves credit. Your credit score is a number given to you by credit agencies that banks, loan and credit companies use to calculate how much interest to charge you for a loan or a line of credit. Scores range from a low of 300 to a high of 850. In the UK, the highest score is 999. If you've never had any credit or loans, your score will be 0. Once you get your first line of credit or your first loan, your initial score will be the base 300. If your score is between 300 and 560, you'll get very high interest charges. If you're above 750, you'll get much lower interest charges. It's that simple. The score itself is made up of 5 dimensions: on-time payments, credit utilization, credit history, credit mix, and new credit. As I mentioned, as soon as you get into the credit game, your score is the default 300. This leaves 550 points up for grabs. On-time payments, or payment history as it's sometimes called, is just a measure of how consistently you make your payments on time. So if you have any loan payments or credit card payments and you for some reason are late making a payment, the company will inform the credit agencies you are late and your score will take a hit. But don't worry too much, it's not the end of the world. If you catch up on your payments in the next cycle, the ding on your credit score will be reduced, but it will hang around for 7 years. So it's very important to get right. But if you can make your payments on time, the longer your streak of making them, the more of a boost it will give your score. On-time payments contribute 35% of your credit score, or a maximum of 192.5 points. So it's one of the most important factors to get right. Your credit utilization is the next most important factor, and it accounts for 30% of your credit score, or 165 points. This measures how well you are using your credit. It factors in how much outstanding debt you have from things like loans and mortgages, what's known as installment debt, because you're paying the debt off in equal installments every month. It also covers what's called revolving debt, which effectively means your credit card. And this is debt you pay off in full, theoretically, each month, only for it to build up again in the next month. Under this measure, you are using your credit well if you've either paid most of your installment debt off, or if you're using your revolving debt sparingly. So if you have a loan and you've paid most of it back, this is good for your installment debt score. If you've just taken out a loan and you still owe most of it, this knocks points off your score. For revolving debt, if you have a credit card with, say, $1,000 credit limit and you're using only around 10% of it, then your score will get a boost. If you're using 90% of it, then your score will take a hit. Next is credit history, and this has a 15% influence on your credit score, or 82.5 points. It measures how long you've been using credit. The longer, the better. So if you've had a credit card for, say, 10 years, this is good for your score. If you've only just got your first credit card, then this won't have much effect either way. But the longer the history of using credit, the better it is for your score. An implication of this is to be careful when closing out old accounts. Let's suppose you have 2 credit cards. One you've had for 10 years and the other you've had for 3. But you don't really use the old one, so you decide to close it off. Well, effectively, you've now reduced your credit history from 10 to 3 years. And so your credit score will take a hit. It's actually an average length of credit history that's used, but the principle is still the same. So be careful when closing out old accounts. Keep them open if it makes sense to. Next, we have credit mix, and it accounts for 10% of your credit score, or 55 points. This measures how many different lines of credit you have open: credit cards, student loans, car loans, and so on. The more, the better. Finally, we have new credit, again with a 10% influence on your score, or 55 points. This measures how often you're asking for more credit. Every time you apply for a new loan or a new credit card, the company you're asking will do a check on your credit report, and this is recorded, and these will stay on your credit report for up to 2 years. The more checks you have, the worse it is for your score, because it's sending a message that you need more credit. So it might signal that you're in trouble financially. Imagine somebody you know who's always asking to borrow money. What signal does that send to you? So now we know how your credit score is calculated. Let's look at how paying off your credit card can boost that score even higher. So the trick is to use your credit card to improve your credit utilization, specifically the revolving debt score. Remember, we saw that if you have a credit card with a limit of $1,000, using only 10% of it is considered a good use of your credit. But this doesn't mean you can't use more of your credit. You're free to spend up to the limit, but the important thing to understand is that the date you pay down that debt is critical for your credit score. So most people think that the best way to use a credit card is to pay it off in full on or just before the due date. And while it's true that this will avoid any interest payments, it's actually only the second best time to pay it off. Every month, your credit card company sends a message to the credit agencies telling them how much of your credit allowance you've used. They send this message on the statement close date. So if your credit card cycle begins on the 1st of the month, your statement close date would normally fall at the end of the month. You then have another 30 days to pay it off. This is the statement due date. But if you wait that long, your outstanding balance will be communicated to the credit agencies on the statement close date. So if you've spent $900 of your $1,000 limit, you've used 90% of your credit limit. And this is what the credit agencies will see. And they'll lower your credit score every time this happens. So the trick is to pay down your credit card about 2 days before your statement close date, leaving only around 10% of the balance open, and not wait until the statement due date. And every month you do this, every month you pay off your credit card a couple of days before the statement due date, your credit score will get a boost. And the best way to make sure this happens consistently every month is to set up an automatic payment routine. And the best one I've found